Good afternoon. My name is Adam Williams, and I am a tax planner with Raymond in our Ann Arbor office. We'll be joined today by Alex August and Stephen Gibson. We're going to break up our presentation into three main sections. My section is going to cover potential changes in tax law, in addition to cryptocurrency, which is a pretty hot topic that we get a lot of questions on. We'll turn it over to Alex August. He's going to talk about international tax, the proposed changes to international tax planning and structuring. And finally, we'll leave it to Stephen Gibson, who's a benefit plan expert, and talk about changes in benefit plans and opportunities for people in the benefit plans. So with that, I'm going to go to my first section, which are potential tax law changes. And when we talk about potential tax law changes, everybody talks about things that are proposed. But sorry, my phone just rang in my office. People talk about tax law changes that are proposed, but let's talk about what is real, what's going to happen. On the next slide, you'll see there are actually two things that are hidden bombs that will happen no matter what happens this year. So you've heard a lot of proposals, a lot of rhetoric. Relevant this year. The one is the R&D capitalization rule. So effective on December 31 or January 1, at the end of this year, beginning next year, you will begin to start capitalizing R&D costs and amortizing them over 5 years. Now, this was included, as I said, in the 2017 tax law as a revenue raiser. It's a way to make it look like they were paying for things by having tax hikes down the road. I think everybody anticipated that before we got to this date, this rule would be repealed. We have a rule that is punishing R&D. So we have credits, yay, and now we're capitalizing. So there's a lot of tax laws that are being proposed to get rid of this, but they're still in committee, and we'll see what happens. Second of all, the interest is going to change its base calculation this year. So starting in January 1 of next year, we're going to have a new rule that says that we no longer can add back amortization depreciation for purposes of calculating what we call new 163J. So new 163J was a rule put in 2017 that says you have excess interest, you cannot deduct that in the current year. And excess interest was defined as more than 30% of your adjusted income. Adjusted income was defined as earnings before interest, taxes, depreciation, and amortization. Now we're losing that piece, and it just goes to EBIT, which means the base for that 30% threshold is going to be going down, which means that more people will be subject to this rule with more interest expense essentially being capitalized and taken in future years. So those are our hidden bombs. Those are enacted laws. Unless there's tax law changes, that's going to happen right now. So let's move on to the Biden proposals. I divide tax law changes that are proposed into three general buckets. It's what I call campaign rhetoric and just kind of talking, then real concrete proposals, and then legislation. So right now we moved in May from having kind of campaign rhetoric, people talking a lot of stuff, to actual concrete proposals being made by the Biden administration. So the Biden administration, two broad proposals with a bunch of sub-proposals that we're going to be talking about. They're released in the Green Book, which is a budgeting document that's released by administrations every year in the spring. We did not have that document for 4 years, but the Biden administration is kind of resurrected from the dead. So we can look at actual hard plans, say, okay, what are they planning to do? What do they really want to do? And they divided it into two groups. One is the American Families Plan. That is a series of changes to income tax laws for individuals. And they are being paid for, almost all increases, to pay for basically a new entitlement program for paid leave, subsidized childcare, and free 2 years of community college training. So the American Families Plan is very individual focused. Today we're focusing more on business proposals. So we're not going to dive into the American Families Plan except for one topic that's covered in the American Families Plan that really impacts flow through businesses. The second group of tax law changes they propose, the American Jobs Plan. So this is a group of proposals focused on corporations, and they are intended to pay for the infrastructure improvements. So all of this is tied to those infrastructure negotiations you hear going on right now. This is what Biden wanted to use to pay for all of this infrastructure spending that they're currently proposing and negotiating the spending piece of it right now. So if we're talking about the American Jobs Plan, next slide, please. What is it? What's in the American Jobs Plan? Well, the baseline one is they plan on raising the corporate tax rate to 28%. Next is various foreign tax reforms my colleague Alex will talk about after I'm done. The third piece is a 15% global minimum tax on corporate book income for large corporations. Large corporations is defined in a way that's for spectacularly large corporations. It is $2 billion of pre-tax income in a year gets you into this 15% minimum tax. So a pretty small group of corporations, even in like the Fortune 500, would actually be subject to this 15% global minimum tax on corporate income. And finally, to expand various credits, these credits were very targeted in the clean energy market. So lots of new taxes, increases, and then some credits to incent activity. This is something they want to do to incent clean energy. So next slide, please. So we talked that the corporate stuff is buried in the American Jobs Plan, but the first thing I want to talk about is actually in the American Families Plan. That's the rationalized net investment income tax and self-employment taxes. Now, there's a glitch, several glitches in the Internal Revenue Code currently, where certain income escapes basically payroll taxes that pay for Medicare. So, for example, based on laws from the 60s and 70s, S corporation income that is distributed out to its shareholders does not pay self-employment tax or net investment income tax if that shareholder is active in the business. Likewise, the same rule exists for people who own limited liability companies and partnerships who are active in the business. So they're trying to say, wait a minute, we intend for everybody to pay Medicare taxes on all of their income. So we're going to try to find ways to close those gaps that currently exist. And they came with, first of all, a hammer. And that was for taxpayers with gross income excess of $400,000, the definition of net investment income tax be amended to include, Sam, my screen just lost your slides. Sorry for that glitch. Okay, we're back again. So for taxpayers with a gross income in excess of $400,000, definition of net income tax be amended to include gross income and gains from any trades or business otherwise not subject to self-employment taxes. So if you're above $400,000, they don't care. They're going to assess net investment income tax on all income, unless it's already been subject to self-employment tax. So that's the big hammer on people who are what they call high income. Then they go down and say, okay, for limited partners and LLC members who provide material participation, we're going to subject your distributor share of income for amounts on that individual piece that exceeds a certain threshold amount. We don't know what that threshold amount is. But again, so the first one is a broad hammer. The second one is narrowly focused on the individual activity. And they do the same thing for self-employment related to S corporations. So this is a big change that will change a lot of structuring thoughts we have. We create a lot of subchapter S corporations for the purposes expressly of avoiding self-employment taxes. And if this law is passed, we are going to have to rethink how we structure organizations. There's lots of structures we have out there to avoid self-employment taxes on partnerships, and they're coming after these structures. These are perfectly legal structures right now. They're within the framework of the law as they are. But the Biden administration feels that our structures and our industry structures are abusive, and they're coming after them. So we have to be prepared for that. Next slide. So I've talked about the Biden proposals and what those proposals are. What happens if we do nothing? We have a new fiscal cliff coming on December 31, 2025. Lots of the changes that are made in 2017 expire. So when that happens, the highest marginal rate goes back to 39.6%. Qualified business income disappears. The standard deduction goes back down to $10,000. The personal exemption returns, the state and local deductions come back. The AMT credit drops down. Child credit tax reduces. It's been expanded a lot in recent years, including getting checks paid out to people during the year. That all goes away in December 31, 2025. The state tax exemption drops down. And we have some other expiring provisions for excess business loss rules. So one of the things that's in the American Jobs Plan is to put the excess business loss rules back in play before it expires. They want that to be made permanent. The rest of the stuff is covered in the American Families Plan, the stuff for individuals. Some of it is already going to happen on December 31, 2025, no matter what. So the highest marginal rate returning of 39.6% is in the Biden proposal, but if he does nothing, he gets that as well. So that gives him more leverage on the American Families Plan than it does in the American Jobs Plan. With that, I'm going to flip over to cryptocurrency, which is the hottest topic us tax people seem to be dealing with. I don't know why we became the cryptocurrency people of everybody, but we get the questions on cryptocurrency. And the short answer is the IRS hates cryptocurrency. And they hate it more now than they did 6 months ago. And the reason is the IRS has a mindset as follows. What is cryptocurrency's purpose? Is it for money laundering? Is it for currency control evasion? Is it a medium for fraud? And I say, or terrorism. Why do I say that? Well, if you think of the Colonial Pipeline hack that occurred a couple months ago, and that was followed up by a hack on a meat processor, those hacks were paid off through ransomware in Bitcoin. So the Biden administration and Treasury are now equating, and have said this explicitly, they believe that cryptocurrency, and Bitcoin in particular, is a vehicle for terrorism. And they're going after it. And the only other purpose they can see for this are people speculating in cryptocurrency for the purposes of the above. Unlike traditional investments and brokerage accounts, the IRS has no optics into people's cryptocurrency holdings. And that has the IRS very upset because they don't know what's going on. There's a black hole. They know it contains lots of value, lots of money. They don't understand why you'd be doing it except for fraudulent reasons to disclose. And they're looking at it and saying, how can we fix this? They estimate 7 to 11% of people have virtual currency holdings as of today. So in 2019, they put a question on Form 1040, and it was buried in Schedule 1. It said, are you holding positions in virtual currency? Then in 2020, they moved that to the top of 1040 itself and says, you receive, sell, exchange, or otherwise acquire financial interest in virtual currency. So the first thing they've done is they're just polling the public. They want to find out who has it. And the second thing they've done is they have subpoenaed various Bitcoin exchanges and gotten information on who owns it. People started receiving letters. Next slide. People started receiving letters that say, hey, we know you have cryptocurrency and we think you're in trouble. So what kind of guidance have they given us to provide our clients on cryptocurrency? Well, in 2014, they issued what we call the original guidance. The original guidance was basically a short series of questions and answers, and all of them kind of repeated the same refrain. That is, cryptocurrency is not currency. Cryptocurrency is an asset. Just like if you invest in a stock or bond, we're treated as an asset. There's very little other information given by the IRS in the original guidance. 5 years later, in 2019, they came out, we call the second piece of guidance. So that's 5 years later. And basically it focused on what we call hard forks or airdrops. That's a kind of narrow, esoteric thing in the cryptocurrency world. But Bitcoin basically did a split, sort of like a stock split, in 2019 that created Bitcoin Cash. And they thought this was important enough to release guidance on that transaction, how to do it. Since then, we're now 2 years out from the second set of guidance, no material guidance. Occasionally, we tweaks to that original FAQ. It's on a website, and it's big news if one question changes. But we don't really know what the IRS's mindset, other than when the IRS speaks to various conferences, they talk about how much they're going to have a big impact in the future. Next slide, please. So what is the future? Well, the first thing they've talked about was they talked about treating cryptocurrency as a foreign bank account. So that's kind of a nuclear bomb kind of disclosure. They clarified in 2019 that this is not the current IRS position. But if they did this sort of reporting, they require anybody with more than $10,000 of cryptocurrency disclose their holdings annually. That would be a pretty major increase in filing obligations, potential penalty exposure, and that would be a real big, sea of change where everybody has to report everything they have. Now, that was kind of like their original kind of thought they're mulling. Now, after those hacks that came in this spring, there were two things that quickly leapt into action. One was the Treasury proposal. So even though, as I said, the IRS emphatically says that cryptocurrency is not currency, Treasury has proposed treating it as currency for purpose of currency controls. In other words, you have to report your transactions in excess of $10,000. So if you have a cash transaction in excess of $10,000, you have to file a FinCEN report disclosing that transaction. And they've said, we may apply that rule to cryptocurrency, which is not a currency. Second of all, in the same book that came out called the Green Book that had Biden's American Families Plan and American Jobs Plan, buried in the American Family Plan was some things on cryptocurrency. And what they said is they believe that crypto assets are rapidly growing and they think there's significant invasion. As such, they proposed expanding Form 1099-K, which is a pretty rare form that covers credit card transactions, to capture cryptocurrency information. If you remember, we talked about how they have no insight into what's going on in cryptocurrency. So they don't have a 1099-B that discloses transactions. They don't have a 1099-INT that shows interest, no 1099-DIV. They want a 1099 that gives them cryptocurrency information. And rather than coming up with a new form, they feel they can regulatorily change without congressional action, Form 1099-K. So use a form that exists and just modify it to fit their needs rather than going to Congress and ask for legislation. They continue to reiterate that they believe there's substantial noncompliance and they have no intention of a voluntary disclosure program. So I believe that next year there's going to be a significant third set of new guidance that's going to come out. And I think it's going to be pretty harsh. It's going to really target cryptocurrency and get a lot of transparency. So with that, I'm going to turn it over to Alex to talk about international transactions.
Well, thank you, Adam. Appreciate that information. My name is Alex August. I'm a tax principal here at Raymond, and I'm going to be talking about some of the international tax proposals, including in the American Jobs Plan. And I'm going to start by talking about the proposed revisions of the GILTI minimum tax regime. By GILTI, once again, GILTI standing for the Global Intangible Low Tax Income Tax Regime that was put in place under TCJA in 2017. So some background information on this global minimum tax GILTI regime. The purpose of the GILTI regime is to ensure that U.S. controlled foreign corporations, we're talking about CFCs, those are foreign corporations owned or controlled by U.S. persons, ensuring that CFCs pay a minimum tax in the U.S. on low-taxed foreign profits. So GILTI applies to CFCs with an income return in excess of 10% on its foreign tangible asset investment. So this 10% foreign asset investment kind of serves as a hurdle over which income has to exceed before being potentially subject to the GILTI tax. The Biden plan increases the effective GILTI tax rate from the current 10.5% to 21% by reducing permitted GILTI deductions coupled with the increased corporate tax rate of 28%. So it's obviously a very significant increase to the tax rate, exactly doubling it. Further, the Biden plan proposes the elimination of the QBI threshold. That the QBI threshold is the 10% qualified business asset income hurdle I just mentioned moments ago. So currently you have to exceed this 10% hurdle before being subject to the GILTI. The Biden plan proposes removing the hurdle, so your first dollar of foreign profits would be potentially subject to GILTI. Next, the Biden plan proposes a requirement of country-by-country reporting. The purpose of this requirement is to prevent blending of high tax and low tax income. So currently, the income of the different countries at different rates can be blended, and sometimes it can even be blended across CFCs. So the Biden plan proposes removing the country by country reporting, thereby increasing or eliminating the ability to blend rates and increasing the overall guilty liability for CFCs. And finally, there's currently a high tax exclusion that's in place for the guilty tax regime. If a CFC is paying a tax rate above 90% of the U.S. rate, which is currently 18.9%, they can elect not to be subject to the guilty tax. The Biden plan proposes the elimination of the high tax exclusion so that election would not be available in the future. Okay, next I'm going to be talking about the proposed elimination of the deduction for foreign derived intangible income, or FDII. And once again, some background information here on the FDII. FDII is the mere opposite image of guilty and rewards U.S. domestic C corporations for having excess profits in the U.S. with respect to foreign sales. The overall goal of guilty, when it was implemented under TCJA, was to incentivize U.S. corporations to keep highly profitable intangible property in the U.S. and not to transfer and develop such property overseas. So currently, a U.S. corporation's income in excess of 10% of its domestic asset investment, so once again, very similar to the guilty concept, but now focused on the domestic side. So U.S. corporations' income in excess of 10% of its domestic asset investment related to export sales is allowed a 37.5% deduction on its foreign-derived intangible income. So what this does is it reduces the effective tax rate on foreign sales from 21% to 13.125%. So it's a very significant deduction for C corporations having foreign sales. So the Biden's take on all of this is arguably, guilty and FDII as they currently exist, reward high foreign investment and low domestic investment. So for that reason, the administration believes that it does not incentivize new domestic investment the way it needs to, and propose its repeal, and they plan on replacing it with some sort of R&D type tax regime. So it's some sort of tax system that would reward U.S. domestic research and development activity. Okay, moving on to the to the next repeal. A lot of repeals here. The Biden plan proposes eliminating the BEAT tax. I know the BEAT tax is a tax that applies to larger corporations. It serves as an alternative minimum tax for U.S. corporations with average gross receipts in excess of $500 million. So once again, a very, very high threshold for very large companies. So it applies to large companies making base erosion payments to foreign related parties. And base erosion payments are payments that reduce the U.S. tax base. So a payment to a foreign related party that reduces U.S. taxable income. Currently, the minimum tax is calculated by 10% of BEAT modified taxable income. And what that means is U.S. taxable income plus adding back base erosion payments times 10% is the calculation of the BEAT tax liability. And that amount is compared to the corporation's regular tax liability, and to the extent that it exceeds, that the BEAT liability exceeds the corporate tax liability, that additional amount is a minimum tax that's additionally paid by the corporation. Now, what the BEAT does not do, the BEAT does not currently distinguish, and never has, it doesn't distinguish between payments subject to high tax or low tax foreign jurisdictions. So for that reason, the Biden administration proposes the elimination of the BEAT and instead establishes a shield, stopping harmful inversions and low tax developments. And what the shield would focus on is payments made to low tax jurisdictions. And that would be no payments with a low effective tax rate. Currently, the administration was proposing a low tax threshold of 21%. So that would mean that any payments made to a foreign related party that's subject to a tax rate of less than 21% would be disallowed in the U.S. tax return. And as mentioned earlier, it applies to financial reporting groups with global revenues in over $500 million. So focused on the larger multinational companies. Now, Adam briefly mentioned this during his presentation, this concept of imposition of a 15% minimum tax on book earnings. This is kind of a revolutionary concept. So now we're kind of crossing over from what has traditionally been taxable income. Now we're looking at financial statements to try and evaluate what taxable income for tax purposes might be. So this would, once again, as Adam mentioned, would apply to worldwide income for multinational groups in excess of $2 billion. So, and this is income, not revenue. So it's, the Treasury estimates only 180 U.S. multinational firms, would be affected by this this new proposed tax. But essentially, it's in a nutshell, it's you would take the multinational company would look at its pre-tax worldwide profits, multiply that by 15%, and then apply certain credits and deductions to determine a worldwide tax liability. And once again, compare that to the corporation's regular tax liability. And that difference would serve as a minimum tax that the corporation would have to pay. And what's, as mentioned, that this notion of incorporating financial statement income is kind of threads throughout a few other items here I'll be talking about here shortly. Regarding other items of I'd say significant international interest, there's a foreign branch profits, current foreign tax credit with respect to foreign branch profits is proposed for a significant change based on country by country reporting. I previously mentioned country by country reporting with respect to GILTI. So now we're looking at foreign tax credits being reported on a country by country basis. So to the extent on a U.S. tax return, you have foreign income and you pay foreign tax, the foreign tax credit determination would be limited on a country by country basis. So once again, this prevents blending of high tax and low tax countries, which would serve to increase or actually reduce. It would serve to reduce the foreign tax credits that would be available and calculated on U.S. tax returns. The next item is these next points aren't as significant, but I think they're worth mentioning. Corporate inversions have kind of been a popular topic over the past 10 years. Corporate inversions describes the concepts of a U.S. corporation converting to a foreign corporation for the purpose of reducing U.S. income tax by transferring profits and taxation to a low tax jurisdiction. There's provisions in the plan to make it more difficult to do that, more costly to do that. Next is a potential additional disallowance on excess business interest. And this is once again a concept that ties into financial statements. It applies to multinational groups with consolidated financial statements. And the potential disallowance equals the member's net interest expense for financial reporting purposes in excess of the member's proportional share of a consolidated group's net interest expense. So once again, this financial statement tie-in, where if for financial statement purposes, if the allocation of interest expense is too high with respect to the overall group, there could be a limitation of that interest expense on the income tax return. And finally, the IRS, as mentioned, they're going to increase audits on large corporations. That's part of their initiatives going forward and plan on making funding available to do so. I know they, over the past several years, have hired and retained many more auditors to focus on larger companies. The last item I wanted to mention regarding, and this is not part of the American Jobs Plan. This is recent developments with regard to global cooperation and global minimum taxes. Recently, the OECD released an outline adopting a global minimum tax rate of at least 15%. So 130 of 139 countries have signed on to this agreement, with key holdouts including the low tax countries of Ireland, Hungary, and some Caribbean nations. And once again, this is a large company focus. It's focused on companies in excess of $750 million of euro in revenue annually, a large company focus. But what's striking about this is that the OECD and the US and the Biden administration heavily backs and supports this initiative, that 130 of 139 nations would agree to this notion of a global minimum tax of at least 15%. So now the next step in the process is that governments, local governments, will now seek to pass laws ensuring that companies headquartered in their countries will pay a minimum tax rate of at least 15%. Now, certainly there's significant political challenges to such a thing. I mean, this has to get, these changes would have to get passed domestically by through Congress. Now, the U.S. passing something like this would certainly be challenging. Then the same process would have to happen in every country throughout the world. So there are big hurdles to cross, along these lines. But what is striking is the overall agreement there seems to be among so many of the economies in our world towards adopting a minimum tax. And certainly this is key to Biden's plan, because the increase of a global minimum tax of 15% makes the U.S. increase the corporate rate to 28% much more palatable, and less likely that a U.S. company might try and locate in low tax jurisdiction if there's very little benefit to be gained. And finally, lastly, I wanted to mention briefly our affiliation with Nexia International. If you do business outside the US or wish to expand your company globally, local knowledge and advice is vital. We are proud to be able to provide this kind of insight through our membership in Nexia International. Nexia is a leading global network of independent accounting and consulting firms. And it just so happens that today, July 22nd, woohoo, we are proudly celebrating Nexia Day. Nexia Day allows member firms to celebrate our ability to provide more responsive, more personal, partner-led services across the world. On the slide here, you can see some key stats about this great organization that includes over 265 member firms across the world. And personally, I've had many occasions where I've had to reach out for local country assistance, where a client has got a tax matter or an accounting matter, but I deal on the tax side. A tax matter overseas, and they need some local country guidance toward its resolution. And the best place to receive that guidance is in a local country. And unfortunately, we have coverage just about all over the world for any tax questions or issues that might come up in a local country that now we're not able to resolve without local country consultation. So it's a great tool for us, and that's certainly available to our clients as well. So with that, it's time for me to introduce my colleague, Stephen Gibson. Take it away, Stephen.
Thanks, Alex. Thanks, Adam. My name is Stephen Gibson. I am a principal with Raymond Wealth. So Raymond Wealth has a large team of dedicated retirement plan experts, providing investment advisory services, TPA services, participant education, etc. We provide services to over $1 billion in retirement plan assets. I'm here today to talk to you about a few things, but first just wanted to point out that we're currently in what we're calling the Great Resignation. Coming out of the pandemic, a lot of staff and employees are taking a look at their current workplace and deciding, is this where I want to be going forward? We're seeing a lot of employees and participants and plans resign, and one major part of that and their decision-making process is the benefit structure. So we're here to talk a little bit about that in more detail. Having a top tier, and I'll start on that slide in just a second. Having a top tier retirement plan can serve many different facets. It can help to hire new staff, it can help to retain staff, and have participants be able to retire, which then in turn helps things as career growth, career progression, as well as reduction of healthcare costs. The truth is, your retirement plan is a vital piece of the success of your organization. But it is also a vital piece of your personal success. Most of these webinars that we do, we're focusing on best practices for investment menu design, fiduciary responsibilities. How can you develop the plan to work best for the participants in the organization? And looking at the attendee list today, we're taking a little bit of a different turn. And instead, we're going to focus on how you yourself can leverage the retirement plan to benefit your position and other key leaders within your organization. We're going to start off by taking a look at plan costs. The most common method for payment of plan expenses is through plan assets. For administration fees, advisor fees, typically they're ran through the plan and they're paid on a pro rata basis, which means the larger account that you have in the plan, the larger your proportion of the plan expense. What's neat or interesting is that in certain situations, there's a better route to doing it, which is looking at having the plan expenses being paid directly by the company. In this instance, we have the left side of the screen and the right side of the screen, looking at a $2 million plan in which the owners make up 75% of the overall plan. So a small business, the owners have been there for a while, they've recently added staff, but the majority of that 401k is theirs. In this case, with plan expenses of 0.85%, the owners would be paying $12,750, and it's the top spot of that left blue box. Whereas the other participants are paying a much smaller share. If the company in this instance were to pay all the fees directly, which seems a little counterintuitive for having the company write a $17,000 check as opposed to the owners of the company paying $12,750 in their plan, it actually makes sense. So if we crunch the math in this particular instance, given the tax rate, which of course could change, and that's just for illustrative purposes, after they take the deduction on the business expense on paying the plan expenses directly, the owners actually pay less money than what they were paying directly out of plan assets. And this allows owners or key leadership to keep more of the money inside of the plan. So it's going to help them out as they grow, as well as being able to talk to the rest of the staff and being able to spend or present the very positive message that the company is paying for all of their administration fees. It really is eating your cake or getting your cake and being able to eat it too. It makes a lot of sense in the right situation. Next slide. The next thing that is very common for individuals who are highly compensated in plans is they want to get the money into the plan as quick as possible. So they do what's known as front loading their contributions. So there may be some attendees on the call here in which this is their process. And the thinking behind it is getting money into the plan as quickly as possible, giving it a greater time or tendency to grow. Where that can backfire is when there is that company match that's being provided, and it's being provided on a per payroll basis. Because if you max out your contribution before the end of the plan year, for the remainder of the plan year, if there's not a true up provision put into place, you're going to miss out on a substantial portion of the company contribution. For example, if you made $120,000 a year and you maxed out in the first 4 months, if the match was 5% of your compensation, you'd be missing out on $4,000 of free money provided by your employer. So the standard way for many people is to try to front load. You really want to look at that alternate way. Do I need to spread out my match? How is it structured? If you're getting it or anticipating a big bonus, how best do you defer on that bonus to maximize the contribution? If there is a true up in place or your match is on a plan year basis, you can front load all you want and you're not going to be negatively impacted. Next slide. So moving on from the match, which is one type of an employer contribution inside of a retirement plan, and shifting over to the other main type of an employer contribution, which is the non-elective or profit sharing contribution. The most standard way to allocate this non-elective contribution is on a uniform percentage of plan compensation. At the end of the year, the company looks at how well they did, sends out a message to the group. Everyone is getting a 2% profit sharing contribution or non-elective contribution, or they're taking the big pot of money and they're splitting it up equally. That's really great because it's very simple and easy to understand, but it really lacks flexibility and control. We're currently in a period right now, which is a restatement cycle opening for retirement plans. So if you're on a prototype or an adoption, volume submitter adoption agreement, if you haven't already, you'll be getting information from your provider saying we need to restate your plan. This is a great time to go through every plan provision in detail. What does it mean? And what is the ideal structure that you should choose? The alternate way in this case is, instead of just using the standard uniform percentage of compensation, going with a new comparability plan design, having each participant be in their own group. What this does, it vastly improves the flexibility that you're able to have. You still have the ability to do the standard way, the uniform percentage of compensation. But now if you have, if you want more flexibility and you want to give a higher percentage to key individuals or a group or people who have been there longer, you have the ability to do so without having to make any modification to the document. There are plenty of other plan design aspects which you may want to think about during the restatement process. So we have, if you're having testing issues, if you're being limited to how much you can put in the plan, consider automatic enrollment or safe harbor contributions. To get even more money into your retirement plan, consider adding the provision allowing for in-plan Roth conversions and using some money outside of the plan to pay the taxes and shifting your pre-tax to Roth money right inside the retirement plan. And even more money in your retirement plan by looking at voluntary after-tax contributions. Doesn't necessarily make sense for some plans, but for some plans, it's a very good opportunity to really get a lot more money into the plan. Next slide. So how can I save for retirement? We're going to spend a few minutes on this slide before moving on to the poll question. It's hard for people, especially highly compensated employees, to be able to save enough money inside of a retirement plan in order to replace the level of income that they need in retirement due to testing restrictions, due to them just having the lifestyle that uses a lot of money and not being able to save enough. So typically, these individuals will max out their 401k deferrals. They'll make IRA contributions if they're available, and they'll utilize taxable accounts. The alternate way, and we see more and more organizations going this route, especially to assist with the recruitment and retention of specific positions, is having additional types of plans in place to provide excess contribution to complement the existing plans that are in place. So things to consider here would be looking at cash balance plans, deferred compensation plans. So within deferred compensation plans, there's salary reduction agreements, allowing employees to delay receipt of the income. There's CERT plans, select plans for groups of participants. There's excess benefit plans for those employees who are limited by IRS restrictions. There's ESOP plans, there's executive bonus plans. There is a ton of flexibility with designing the compensation structure to meet the needs of not only yourself and other executives, but of other participants in the process. Another planning item which you may want to consider is ask your provider, in the event that you have Roth contributions and pre-tax contributions inside of your plan, if you have the ability to invest that Roth portion differently than your pre-tax, right? So keeping the same overall portfolio, it may make sense to use your Roth account for more risky, higher potential growth positions, and your pre-tax account for more conservative positions. You know, the idea would be to get your Roth account to be as large as possible while maintaining the same portfolio risk. Going into retirement, if you have $1 million, if you have 500,000 of each pre-tax and Roth, or if you have the other instance, if you were able to have 700,000 in Roth, 300 in pre-tax, that setup is going to take you a little bit further down the road. And lastly, on a similar but different topic, if you have tax deferred and taxable accounts, it's very important to consider what types of investments should be held in what vehicle. So looking at how much dividends and capital gains are being produced and what makes sense to be held in your taxable account and what makes sense to be held in your tax deferred account. We do have one polling question if we go on to the next slide. Do you feel comfortable your organization's retirement plan is optimally designed?
Great presentation, Stephen. So we're seeing a pretty even mix of yes and no, and then a small percentage of, I don't fully know the design of my plan.
You know, that is surprising. I would expect the don't fully know the design of my plan to get a little bit of a higher take up, just because plan design is incredibly complex. You know, looking at things like definition of compensation, right? Are bonuses included, excluded, eligibility, entry dates, all of that. It's very, very complex. One of the things that we offer here at Raymond is the ability to take a really deep dive into an organization's retirement plan for no cost. So we can go through that plan design step by step, explain what everything means, and if it's set up ideally. There's not a cost for that. We also benchmark plan costs in the process just to give a little bit more of a comfort feeling, so that way the next time we do this presentation, there would be a few more yes bullets.
That's excellent. Well, with that, we're going to move on to the question portion, the Q&A. So we'll welcome all of our speakers back. So thank you all so much for all the excellent knowledge and information shared today. It really is going to show that two critical things are happening this year: the need for good planning and good internet. So thank you for all of our listeners for kind of bearing with us there through a few occasional glitches. We had one or two questions come in, and it looks like this first one is for my tax advisors. So we've heard a lot from the Green Book. Adam, I know you read that all the time. It's your favorite, just nonstop reading. We've seen Green Book, we've seen proposals. What are we expecting in relation to timing? We were hearing the fall. Is there anything that we are expecting in a timing with it?
It always seems to be that tax legislation hit right at year end to the beginning of the year. There's this just whole panic that sets in, usually December timeframe. If you look back to when major tax legislation has happened recently, the 2017 tax laws were passed on December 12th, or sorry, December 22nd. I remember that date, it's my daughter's birthday. So on December 22nd was when we got the big 2017 ones. It also normally part of the extenders package. That usually happens the last week of December, first week of January. We really are hoping that if anything happens, it happens within the calendar year 2021 for people who issue GAAP-based financial statements. It's a real pain. We have those year straddling issues. But I don't think we're going to see legislation enacted that looks much like what we've seen proposed. I think there's going to be a lot of horse trading. I think some of the provisions seem to be put in here as bait to basically be thrown away in a negotiation. They asked for a lot of tax increases that are really politically unpalatable. We didn't talk about the capital gains tax or the gift and estate tax reforms that are in here, but there's just not a lot of political will there. I do think we're going to see something as part of the infrastructure packages, maybe next couple of weeks. But I think that's going to be much more on the credits and incentive side. The energy credits, the green energy kind of stuff. There were some provisions in there about some other kind of things, but for the most part, this seems to be an infrastructure package that's basically debt financed until a tax increase package can be passed, or it's just going to be debt financed again, like a lot of the packages have been. The one thing the Biden administration wanted to throw into this infrastructure package was the increased IRS enforcement, which you'd think would be a pretty easy way to raise revenue. Hey, there's a lot of revenue slipping through the cracks because the IRS is not adequately funded. Let's fund them better. And that was in the American Families Plan piece of the Biden proposals. and the Republicans are not on board with just increasing IRS funding. So any revenue raiser seems to be off the table.
That was great. No, I always appreciate your knowledge in that area. And I know we had a question or two on the estate planning and gifting. So we know this is a large area. The firm will continue to put out content in relation to articles, additional webinars. This is something that it's going to take a pretty extensive knowledge base on, and we're going to continue getting in front of everyone with that. So make sure to stay tuned to all your Raymond communications. Shameless plug there. Alex, thank you so much for pointing out Nexia Day. Woohoo. So we've been a member of Nexia Day for quite a while here. In relation to international, kind of the same thing. We're seeing a lot of proposals. I know we've been putting out a lot of great articles. Is there anything we can do in relation to planning now? Is this something just to meet with the advisors, kind of think about what we're seeing and hearing?
With respect to international transactions?
Yep.
Yeah, there's so many significant developments on the forefront here, certainly with respect to GILTI and FDII. The GILTI changes, the increased tax rate, essentially doubling, is something we'll have to keep an eye on. I know the GILTI and the FDII kind of work hand in hand in conjunction with each other. I would expect any changes there, if there are any. And once again, this has to get through Congress, a very divided Congress. So, so much of this is uncertain at this point.
Sure.
But I would expect if there is a change along with respect to GILTI, there will probably be a corresponding change with FDII to some level, because they are so tightly tied together. I guess the one takeaway I would have, and I think this is further down the road, is this tie-in with financial statement income. All of a sudden, tax liabilities might be tied into financial reporting, which has always been a separate entity upon itself. I think there's a lot of frustration out there with corporations reporting very large financial statement income and reporting very little tax profits. So that I think that's something to keep an eye on. But once again, those are bigger company issues. I don't see that trickling down to smaller companies, at least not in the near term. And this global minimum tax is there seems to be a lot of momentum there for establishing a global minimum tax by most of the countries in the world. So that's something to keep an eye on, because that's something that seems to have a lot of momentum. Now it has to get through local legislation. Probably the most difficult of that being in the U.S., but I think a lot of other countries are a lot more progressive than the U.S. is regarding these enforcing these global minimum taxes. So that's something to be aware of, and I guess that's certainly good news for the administration, because that would discourage any offshoring of activity to other countries, because the benefits just won't be there the way they are currently.
Absolutely. Well, thank you for those closing thoughts. Appreciate that. There's a lot to cover. We spoke a bit before we all jumped on this webinar today about how detailed international can get. So I know the team is working very tirelessly on all the different intricacies of these and what that can all look like. And then Stephen, just any closing thoughts? I know when we're talking about retirement planning, I'm not sure if there's an average timing of when people want to review those plans. We talk a lot about education of associates within companies and what that looks like. I'm not sure if we had a question on how often someone should look at their plan based on your poll on their readiness. Do you have any guidance there?
Yeah, so given that we're in the current restatement cycle, it's a great opportunity to review it. At least annually, you want to bring that out, read through it, make sure that it still fits within the guidelines, especially coming out of the pandemic. The workforce is changing. Things are a little bit more transitional. We're also in the term or phrase I'd like to call the great consolidation. Just this week, a day or two ago, Empower announced that they were purchasing Prudential's retirement plan business. And this comes after several other purchases and consolidations of these major record keepers, advisors, TPAs. When something like that happens, it's another opportunity where you should be doing additional due diligence, making sure that the provider that just bought your provider is still the best fit for your participants. So I would say at least annually, Make sure you're taking notes of everything as well. So one of the big things is when you're meeting as a committee, documenting the decisions that are made, filing those away, very, very important. It's not necessarily the decision you reach, but showing the thought process that went into it.
Fantastic. Well, listen, the three of you are off the hook. Thank you all so much for all your time today and all your information. For all of you who attended today, again, thank you. The recording and slide deck will be sent your way, and we are having one webinar a month on great topics. The next one to see coming up in this series is focused on business transition planning. Hot topic. We're seeing this with a lot of clients. A lot of networks are really having a lot to say in this space. So stay tuned. We're looking at August 24th. More information coming your way. Thanks all again and have a wonderful day.